So Teagen is letting everybody in the room, which is awesome. Excited about today. Just finished our top agent in-person mastermind. We had people flying in from all over the place. It was packed, which was kind of fun. Went over tips and tricks from family reunion. And just so you guys know, if you ever want to fly in, it's the fourth Tuesday of every month right here in Scottsdale. You're more than welcome to, but you have to register because it sold out in the first week this month. So we had a packed room, but it was super fun, really fun. So while Teagen's letting everybody in the room, let me know who's in the room. Type in the chat box. Let me know where you are coming from, what city, what state, or country. And Teagen, you're gonna have to read them to me because I'm too far away from the monitor to see it.
We are waiting for them to start flying in.
Okay.
Got Wisconsin. I know we've got some of our Alaska peeps on here. Got Charlotte. We've got Cleveland, Phoenix, Michigan, Richmond, Virginia, Chicago, Wasilla. We got full West Coast to East Coast going on today.
Very cool. Awesome. I was talking to California earlier today. So we should have a good group. Last time there was so many great questions asked. So just know that there's going to be plenty of time at the end for questions. Jot them down and so that I can make sure that I get to all of your questions. And so let's get started. So as you guys know, this is our 11th month that we've done this wealth building series. And this month we wanted to talk about the path of money. So it's our 11th month doing it. But the path of money is super important because money can take a couple of different paths, and we're going to go through that and what it looks like and where the risk is, where the opportunities are, but understanding the path of money, because here's the thing with money, there's rules to money. And if you follow the rules, you'll make money. If you don't follow the rules, you won't. So I want to teach you the rules as Gary has taught them to me. Literally, this is exactly one of the presentations that Gary did teach to me. So let's get started with the path of money. So let me get my screen going here. The path of money is full of wrong turns. The key is learning when and where to invest your income in order to avoid getting lost on the way to your personal and professional wealth goals. Gary also talked a lot about in the Top Agent Mastermind at Family Reunion about wealth and about getting to your goals and what's getting in the way. So the first thing that, when Gary explained it, and I've heard Ben Kenny talk about it in this way too, there's really two sources of money. There's two kinds of capital, if you will. There's human capital, which is you work for your money, meaning you trade time for money. So that would be our job. So my job is running the Kristen Cole Real Estate Network. However, my money can be involved in other things, like I own other market centers. I'm the OP, but I'm not the driver, meaning I'm not the team leader. I own some title companies, but again, I'm not the driver of it. So when I'm thinking about trading my time for money, it's what I do in leading KCN. For probably most of you, it's listing and selling real estate. That's your trading time for money. And then when you have a capital assets is the money that works for you. It's when you take that money, you set aside some of that money that you've earned by trading time for money, you set it aside and actually put it to work for you in an asset. And that can look a couple of different ways. And we're going to go through that. Kind of cut it off a little bit here on camera, but whether it's human capital or capital assets, the truth is either way, you've got to have cash flow if you want to build your wealth and you want to invest. So let's look at the four choices that you have with cash flow. So when you either trade time for money or you've earned money on your investment, you can do one of these four things. You can save it, you can invest it, you can donate it, or you can spend it. So the little light bulb, you're going to see little light bulbs on these slides. And they're kind of like, okay, pay attention to this. And paying yourself first and investing in your discretionary funds, meaning the funds that you have left over toward achieving your financial goals, and then leave the rest for daily expenses. So paying yourself first. So setting aside, making a decision, I'm going to set aside 10% of my money or 20% of my money in order for me to invest in an asset that will start producing an income for me. So it might be a multifamily asset. It might be a business. It might be stocks and bonds. It can be a variety of different things. We're going to look at all of them today, but understand that there's really only four choices. And for most people, they will spend it and maybe save a little of it. And so then you find yourself trading cash or time for money your entire life. And then you get to retirement age and you find that you either have to reduce your lifestyle because you don't have enough money coming in from Social Security to maintain the lifestyle you've had. We don't want that for you. We want you're in real estate or you work with somebody in real estate, and we want you to learn how to invest in the things that you know. We want you to understand how to invest in things you don't know. So how would you invest in the stock market if you don't understand stocks? So we're going to talk about that. So investing tips. So if you think about it, money is money. Money is good for the good that money can do. So you can lend it or you can buy things with it. So you can either loan money to people for buying and investing or purchasing their, and owning things directly. So when you think about money, there's passively lending money and there's actively lending money. So a passive way of lending money might be putting money in the stock market, putting money in CDs and bonds and treasury bills. And you think lending it, that doesn't make sense. Well, you're actually, if you buy, for instance, a T-bill or you buy a municipal bond, you're actually loaning them money so that they can do a road project or something like that. And they're going to pay you back with taxes that they receive from taxpayers that they built the road for. So let's just use municipal bonds as an example. So if you buy a municipal bond, what you're really doing is lending that money to that city who goes out and builds a road. And then they, charge, or they get the money back either through tolls or taxes, and then they pay you back. Well, when you think about that kind of an investment, it's low risk, especially if it's a municipal bond that's considered Class A. And so, but if you have low risk, you're also going to have low reward. So when you think about investing, depending on how much risk is involved, will be directly relational to the return on your investment. So investing involves either passive or active lending or owning. So I just gave you an example of lending. Even though we don't think of it as lending, we do. Passive lending options, as I mentioned, can be T-bills, bonds, CDs, money markets. So when you deposit money in a money market account, you're essentially lending it and receiving a low interest in return, which often doesn't keep up with inflation. That's the problem. If it's only earning 1 or 2 or 3%, and inflation right now is at 6.4%, you're going backwards, but it's risk-free because most of it's backed by the city or it's backed by the US government. And so sometimes when people don't have a place to park their money because they're either saving up to buy a property or buy a business or something of that nature, they'll put it in something like this that's pretty risk-free so that the majority of their money is there when they're ready to make the purchase. So it might not offset all of inflation, but it should offset probably right now today, probably half of it. So a couple of years ago, if you went and put something in a CD, you probably got 1/4 or 1/2 of 1%. Today, it's better than that. T-bills can be better than that. Municipal bonds can be better than that. But the point is, it's safety. It's more safe than anything else, which is why it produces a lower return than anything else. If you're passively owning, so we just talked about lending money to cities, to, with municipal bonds or treasury bills, you're loaning money to the US government. When we talk about owning, passively owning, that would mean buying a stock or buying a REIT, real estate investment trust, buying a mutual fund that's being managed by someone else. So basically, let's think about a real estate investment trust. So if I go out, I'm managing that fund, I'll go out and buy, like Blackstone does, I'll buy a bunch of homes with the money that you're investing in this REIT, and then I will rent them out. And after all the expenses, I will send you a return on your investment, either through a dividend or at some point when you cash out of the property, you would receive your, whatever the appreciation has been in addition to that dividend. So that would be, instead of lending money, that's where you actually own something. You do own part of that REIT, that real estate investment trust. When you buy a stock, like you buy 2% of Apple stock, you own part of Apple. But those stocks or those REITs or mutual funds are being actively managed by someone else. So that's where you actually buy into them and own them. Now, I'll get to this a little later, but one of the reasons that you would maybe want to buy an index fund, for instance, is because if you don't know a lot about the stock market, I would not want to buy an individual stock, because I don't watch stocks. I'm not in that market all the time. So if I wanted to put money in the stock market, I would probably put it in an index fund that mirrors the S&P 500. And Vanguard has one of those, and we could talk about that. But so just remember that passively means you can either lend it or you can own it. So lending it is like tax-free municipal bonds that you're lending to a city to maybe build a road. Owning it, like owning a REIT, real estate investment trust, or owning a money market account or a stock that's being managed by someone else. That's passive. Passive means somebody else is managing it. It's not you. So passive lending and owning, the challenge is that you're not in control. They are. And so if you're okay with that, that's fine. Like I'm super okay with Vanguard being in control of my my index fund, because it mirrors the S&P 500. So it's just going to do what the S&P does. So I just, every year add so much to that. In that particular case, it's part of my 401k or my traditional IRA. And I just leave it there and I don't pay any attention to it, but they control it, not me. When you're actively investing, you control it. And so when you control it and you're actively investing, as you can imagine, there's a lot more risk. And so there's a bigger return. But it better be in something because there's a lot more risk. So passive investments generally yield a lower return, typically less than 3%, while in today's world, while passive ownership of a business and stocks can yield the returns between 8 and 12%. So if you own stocks, S&P 500 on average over 30 years, typically produces between 8 and 12%. So I wouldn't try to outguess the S&P 500. If I was going to own stocks and bonds, which I do, I just buy index funds which mirror the S&P, and I just don't even think about that money. It's like, for me, it's like putting it away for a retirement. But the key to this is you've got to leave the money actually in the market to achieve returns. And they've shown several different times where people, they had to take the money out for a loan on their house, to buy a house or something, they were going to put the money back, but they had to take it out. And they've just shown that there's different times where if you took your money out at that moment and then put it back in later, the significant change in the return that you'll receive. So if you are going to put money in the stock market, particularly in an index fund or something like that. I did it for my children when they were very young. I put a small amount of money in, and it's just been in there ever since. And it slowly starts to grow. And then we had the crash of 2008. Once it came back, now it's going to, if they just leave it alone over time, it's going to produce quite the return for them. So taking the money in and out of something like this is not a good idea. So you wouldn't want to put money in the stock market and then all of a sudden need money and have to cash it in, because most likely you're going to lose. So if you cannot beat, like it says there, if you cannot beat an 8 to 12% return, don't try to pick individual stocks yourself. Just invest in an index fund. And in particular, the one I invest in, it's called VTSAX, which is the Vanguard Total Stock Market. Okay, so what are some investing tips? So when you, on the left-hand side of the screen, you'll see low return investment options. On the right-hand side of the screen, you're going to see high return investment options. Just remember, the higher the return, the higher the risk. The lower the return, the lower the risk. And most likely they control it versus you controlling it. So again, if you just look at these, passive lending involves investing money that is actively used by others. So you're lending it to them to you, and they get to use it. You lend it, you buy a tax-free municipal bond, and you lend it to the city, and they go out and use it to build a road. So that'd be a great example. Passive ownership, which is different than lending, involves investing money to own an asset, such as a stock or a mutual fund. And my recommendation is, if you're going to own a stock or a mutual fund, that you invest in an index fund, unless you absolutely are a guru at picking stocks, which most of us aren't. The security of your money is either highly secure or insecure. It's highly secure when the return is low, and it's more insecure when the return is high. So when something with a highly insecure asset, they will pay you the least amount of money. But when it becomes less secure, the higher the amount of the return that you can expect, but they control it. So, even though the super majority of my money is in real estate and businesses, I still have money in the stock market, but I just do it with an index fund. And I just don't even think about that money. I'm just like thinking, just save it for later. A high return investment options, where you control it, you can actively lend. For instance, you could own or finance a property for somebody. Maybe you own a property free and clear. You could own or finance a property. You could privately lend, which would be like a hard money loan. You can get a high interest rate if you do a hard money loan. Hard money loan is where you loan somebody money. It's secured with something, either an asset or with, their personal guarantee or something, and they are borrowing it from you in order to maybe flip a property. So that would be lending. Actively lending would be owner financing, hard money loans, flips, things like that people are borrowing money from you to go use it to do what they want to do with it. But the difference between that and doing it with the municipal bonds with the city is that when you do hard money loans, when you do an owner finance, you're in control. So you're in control of that. You get to choose whether or not you do an owner finance and who you do it with. You get to choose whether or not to let someone borrow money to do a flip or not. So you're in control. So actively owning something, which is different than lending it, is where you're going to get the highest return. And for that mostly centers around businesses and real estate. So when you actively own real estate, because of all the additional pieces of real estate that allow you to earn a higher return, like being able to write off the interest you pay, being able to depreciate that asset if it's a rental and you're not living in it, writing off the taxes, that reduces your taxes that you have to pay the government. So in addition to appreciation over time, you also get the tax benefits today. So real estate and or businesses are something that you're actively involved with, actively owning it, so you control it. And the wealthiest people in the world own businesses and real estate. It also it has the highest risk. So you wouldn't want to go buy a business that you don't know anything about. I'm not going to go buy a retail store that sells ladies' clothing, because I don't know anything about the retail business. I'm not going to go buy a McDonald's. I don't know anything about the restaurant business, but I might go buy a Keller Williams Market Center that I know a lot about. So for me, and I think for most people, when owning businesses and real estate, buy what you know. Like, I understand multifamily. I understand small single tenant commercial buildings. I understand land. I understand real estate businesses. So for me, I'm not going to go buy Taco Bell that I know nothing about. I'm going to stick with what I know because I have the highest chance of succeeding. So the less secure your money, the less secure your money, the higher the return of it. So if you're going into a business that, in this market, buying a real estate company right now is pretty volatile because of our market. You can expect a higher return, assuming that you're going to be able to make the business work, because typically with higher risk comes higher reward. So the super important thing is that if you get into business with someone, you buy a business with someone, or you lend them a hard money loan, the character of the person that you're getting into business with, or the character of the borrower of that money, is key. Because anyone can come and ask you to borrow money to do a flip, but if they don't know what they're doing, and you've never dealt with them before, you may end up losing your money. So the character of the person wanting to borrow money from you, or the character of the person that you're getting into business with, is really the key to making a higher return on your investment. The good thing is everything on the right-hand side of the page, you actually are in control of it. Most of us want to control our money, at least to some degree. And so lending money out, there's an investor in our office that lends money out for hard money loans all the time. I've lent money out for hard money loans before. So you can lend it, or you can actually own it. You can buy a business, you could buy real estate. I own 31 doors in Kansas City. I own property in Alaska. I own property in Arizona. So owning real estate makes sense to me because I know real estate. So I have the highest chance of succeeding by investing in what I know, and I get to control it. So again, just when you think about actively versus passively and control, you really want to think about whether it's important for you. Like when I think about my Vanguard account or the index funds that I'm involved with, I don't even think about it. As a matter of fact, when the statement comes in the mail, I don't even open them because it doesn't matter to me. I'm not going to pull the money out. I'm going to leave it there because I know over time that the stock market will produce an 8 to 12% return, and I don't intend to take the money out. And I'm just leaving it in there. The problem with that is at some point, the government will make you take it out. Like at age 70 and a half, you have to start taking some of that money out. Well, what happens if it's a bull market right then? And you're forced to take some of that money out? You could lose money. Yeah, you can. But for me, it's just a little bit of diversification within the money that I have. So because I have had W-2 income in the past, I do have a 401k. I do also have a traditional IRA. So I recognize that at some age, I will need to start pulling that money out. And if the stock market is down at the time, like it is right now, it's going to stink because I'm going to be subject to the government requiring me to take that money out. So it may be, let's just say that I was like 68 and the stock market's doing phenomenal. I might choose to take that money out early and just pay long-term capital gains on it so that I'm not going to be subject to the bear market that might happen just because I happen to turn, when I happen to turn 70 and a half, the market happens to be down at that moment. So there's ways that you can control it. There's also ways that you can, do a mix of bonds and stocks so that it minimizes that risk for you. But just understand that when you put your money in the stock market, you are buying into a fund that's not managed by you. It's managed by someone else. So my preference is the majority of the money, when I've traded time for money and taken my money and set it aside and invested in something, the majority of my money has been invested in real estate. And primarily, although I've done some land deals and a couple of big commercial buildings over the years, primarily it's been in multifamily because I understand multifamily. And also think about this, multifamily is a hedge. Because think about this, if when the real estate market slows down and people aren't buying and selling, people still have to have a place to live. So typically when the real estate market is under pressure, rents go up. So in the last few years, rents have gone up significantly because there wasn't enough inventory for the people that really wanted to buy. So they had to rent. And so it becomes kind of a little bit of a hedge. Like I'll give you a great example. In 2003, I built 6 fourplexes in Alaska. And in 2008, the value of those fourplexes, if I would to have sold them, went to 50%. They went down 50%. So if I had sold them, I would have lost money, but I didn't sell them. And here's the interesting thing. During the downturn in 2008, the rents didn't change because the people that were losing their houses had to rent somewhere. So my rents didn't change. As a matter of fact, they went up a little bit. And then when I sold them in 2018, which was 14 years later, I doubled my money. So the value that I sold them for compared to what I built them for was double. And during the downturns, I never lost money because the rents actually went up. So I was making my payment and making money. So I see multifamily as a hedge against the volatility that sometimes can happen in the real estate market. So as long as you don't intend to sell anytime soon, which I don't, usually when I buy multifamily, I'm looking at a 10-year horizon. And if you look at the trend line of housing and multifamily properties, it's on average, it goes up 4% per year. Now it's not a straight line, but over time, there's a 4% trend line. So I know if I intend to own it at least 10 years, I run a very small risk of having to get out at any time that the market is on the decline. And in the meantime, if the market has declined, my rents are still going to be there. I see real estate or multifamily real estate, honestly, as a hedge against residential real estate. So I like owning rental properties. But what I can say is with any active investment, you have to make your money going in. So what do I mean by that? If you're going to lend somebody money for a hard money loan, you need to examine the character of the person that you're lending money to. Like, what are they going to do with it? They're going to do a flip. Was this the first flip they've ever done? Is the money that you're loaning them adequately collateralized with the property that they're flipping? Do they have adequate insurance in case something happens, either the building burns down or somebody gets hurt? So there's a lot of things that you need to be aware of if you're going to do some sort of hard money lending like that, or, doing a fix and flip yourself. So you want to make sure that you're thinking about how to protect yourself if you're actively investing by either lending your money or if you are buying assets, meaning real estate and businesses. So for me, I think of it as this way. I segment my money. So there's a certain amount of my money that I want to take less risk with. So, I want to put that in something that's pretty safe and secure. And then there's a certain amount of my money that I'm willing to take some risk, but it's always risk in what I know, not something I don't know. So I might put money in my Vanguard Total Stock Market Index Fund that's not risky. And yet I might be willing to take a certain amount of money and maybe put it in multifamily. And then I might take a certain amount and set it aside to buy a business when a business becomes available that I know is going to be riskier, more volatile than real estate or Vanguard Index Fund. So I think you have to really sit down and segment how much risk are you willing to take? And I think that's directly a function of your age and where you are in your life. You know, when I was younger, I probably was willing to take more risk. As you get older, you tend to be more risk averse because you don't have as much time to make something up if something goes wrong. But I would say that while some people would consider some of the investing I do risky, it's not risky to me. And it's not risky to me because I understand it. I don't invest in things that I don't understand or don't know anything about. And then, so, you know, there's always risk involved. And just know with anything that you invest in, it's going to take your time, either your time, your talent, or your money, or all three of them. At this point in my life, it doesn't usually take my time. Like, I don't manage my own multifamily. I have a property manager who does that. So it doesn't take my time, but it did take my money. If I'm buying a business, you know, it may take my influence to find the right talent, may take my money. But hopefully the goal would be it maybe taking an hour a week of accountability, but that it's not taking all my time. So I always think of it that way. How much of my time is this investment going to take? And how risky is it? And is that something I'm willing to do today? And again, just repeating that actively lending, when I was doing active hard money loans, it was really based on the collateral and the character of the borrower. I did a hard money loan earlier this year, but it was based on a track record that was proven. And so I was willing to take the risk. So it's always risk reward. And for someone may think something's more risky than another. And it just depends on how much do you know about it? How much do you understand about new construction, for instance? How much do you understand about fix and flips? So I always put my money in something that I know something about if I'm going to actively lend it or actively buy something. If I'm passively doing it where somebody else is going to manage it, then I'm going to put it in something pretty secure like an index fund. So the rule of 72, most of you probably have heard of the rule of 72, but basically it's how many years does it take for you to double your money? So for instance, at 7%, it usually will take 10 years for you to double your money. So if you put $100 in today and you could get 7% interest, you would have $200 in 10 years. The goal of compounding, which they say is the eighth wonder of the world, is to put money in over time, like $100 a month over time. And so there's a significant difference between, like, for instance, 36,000 at putting in $100 a month over time. And because that might yield, $36 or $100,000 in 30 years. If you put in $100 a month, in 10 years, you're going to have $36,000. So there's a big difference between 36 and 100,000 over a 30-year period of time. And the difference is whether you're putting in $100 or you're putting in $10,000 will make a big difference. So for me, the earlier that you can put money in, if you're going to put money in the stock market, an index fund or anything like that, the earlier you can put it in, the more time it will allow for more time for that investment. So for instance, when my kids were younger and I would hire them to put labels on my postcards, because back then that's what we did. You couldn't just send them to a mailing house and go out. You had to order them in bulk, and then you had to print labels, and then you had to put the label on the postcards. I would hire my kids to do it. And then I would buy an index fund for them and I would use that money that they earned. It's called a simple IRA. And when they were young, I put a certain amount of money in that IRA. Well, younger. And today, it has grown, like it has doubled several times. But it was because I put a larger amount in when they were young. If you're older, if you're over 50, you're going to have to put in a large sum of money right now to get to your goal because you just started later. And there's a rule of compounding and you just can't get there. There's no get rich scheme. There's no get rich fast when it comes to passively investing. If you can actively invest and you can buy real estate and or businesses, you can make up time faster than you can if it's just compounding as a passive investment. And sometimes, when I talk with younger people, I suggest they go partner up with somebody. Go partner up with somebody that has already done it and do it with them so that you can learn the ropes, learn how to do a fix and flip, learn how to buy a multifamily. And so if I'm partnering with somebody young, I say, okay, I'll use my money and you use your time. So you're the one that's going to be doing the work and the fix and flip, not me. And then we'll split the money in the end. So, so for me, and I wouldn't do that for just anybody. They'd have to be somebody that, like character matters. But sometimes I would just recommend that people go find a partner to do it the first time, because anytime you do something the first time, you learn a lot. When you pay cash for a property, which I've done before as well, the cash on cash return can be, typically it's around 4 to 6%. It can be as high as 10, but typically 4 to 6%. But if you use leverage, meaning you get a loan at the right time, considering appreciation, depreciation, and interest expense, if you get a loan, you can actually get a higher return than you can with cash on cash, because you're putting in a lot. If you're putting in $20,000 for a duplex and you're getting back $30,000 a year in profit, that cash on cash return is much higher than if I bought the property at $250 and I'm getting $30,000 a year back. I hope you guys can see the difference. So the cash on cash return may be better. However, I make sure that if I'm going to get a loan on a property, I never get a loan more than 70%, because I want to make sure if the real estate market changes that I can reduce my rents lower than anybody else and still make my payment. So that's kind of how you make money going in is I think worst case scenario, because I've lived through 6 worst case scenarios in my 39-year career. And I want to make sure that I can afford that property regardless of what the market does. So am I going into the property with enough cash that it doesn't matter what rents do, I can still lower my rent below anybody that competes with me and make my payment. So that's what I mean by making your money going in. Buying below market value, or putting enough down payment to where it doesn't matter what the market does, you're going to be able to make your payment. So making sure that you think about that going into an investment. If you're going into buying a property with only the thought of appreciation, then you're really not an investor. You're a speculator. I'm not a speculator. I may have speculated a little when I was younger and I didn't know any better, but today I don't speculate. Today it's an investment. So I go into the property, with the mindset that I bought it below market value and that I've put enough in a down payment such that doesn't matter how low the rents go, I can lower my rent enough to always keep my rentals full and to make my payment. So make your money going in. The flip side of the real estate market. There's really no downside to investing as long as you don't violate money rules. So what are money rules? Number 1, make your money going in. So if you make your money going in and you buy below value, you are an investor. If you go into an investment hoping for appreciation, you are a speculator. And there's, being a speculator, you might get it right. The market might go up and you're going to think you're a genius and it was just the market that saved your butt. So I always think about going in, putting the money enough money down or buying below value. There's deals everywhere. The reason that you don't find them is because you don't look for a deal till you need one. But if you get up every day and on your ride to work or on your drive around town, you're always looking for an opportunity and people know you're looking for an opportunity, they'll show up. But if you're just waiting until you have, the right money, because if you find the right investment, you find the right property that makes a total sense, you're going to be able to find the money. So that's why I say go looking for investments, because if you find the right investment, even if you don't have the money, somebody else will partner with you, or they will buy an option from you, meaning to assign the property to them. If you're an investor, then you're always looking for an investment. Number two, make sure you can afford to make the payment, even when the rental, even if the renter disappears. You have a vacancy for a couple of months. Can you afford the payment? Another couple key things in terms of making money quickly, the fastest way to make money in the real estate market is to change the use. So maybe you have something that's zoned R1. However, because the city has grown up and things have changed, you've got commercial around you and it's a right-hand turn off of a street, and you go in and change the use to multifamily or commercial, you've automatically increased the value of the property if you can get the use of the property changed. So that's one way to make money quickly, is changing the use of the property. Now that means you're going to have to go to city council meetings and plead your case as to why this is a good idea for the community and all of that. One time I took a 2.5 acre parcel and went to our borough and went before the planning committee and got them to do what's called a flag lot, which is basically splitting the lot in half and leaving one section of it that has access all the way out to the road so that both parcels have access to the road. And by doing so, and it was zoned multifamily, I was able to build 2 fourplexes on that 2.5 acres instead of just one. Well, I just saved the cost of the land for the second fourplex. So changing the usage is the fastest way to make money in real estate. Invest actively, don't be lazy, meaning always be looking for an investment, because you find an investment, I guarantee you'll find somebody that has the money that will partner with you, or they will buy your position in the property. And then owning a business is all about actively making it more valuable. You can make more money if you make good decisions and hire the right people. So owning a business is always about hiring the right people. So I've talked for a good 45 minutes, which means we still have 10 minutes left for questions. This is something I've done a lot, and I don't know, you can either type your questions in the chat box or you can come off of mute and ask me. But I'm happy. Last time we had a lot of good questions. So let me know what questions you've got and I'll tackle them for you. You guys have to have some questions. Last time you had a ton of them.
A couple people commented in the chat while you were talking, just some ahas that, character of who you get into business with is key. And I think that that's really important. Sometimes it's easy to see an opportunity and get excited and just be ready to move forward without maybe investigating some of those things that you talked about.
So let me just comment on that real quickly, Teagen, because I bought a brokerage, a Keller Williams office in 2012, and there were 12 owners, and this market center had not done well. And I bought all of them but 2 out. I bought them out because all they wanted to do was collect a check. They didn't want to do any work. And so I bought them all. I bought all of them but 2 out. And those 2 that I did not buy out, I'm still in business with today. So, character does matter. Who you're in business with matters.
What is the hottest use of real estate right now? I'm referring to the fastest way to make money in real estate.
I can tell you what's not the hottest right now, and that would be retail, and commercial buildings with multi-tenant, those would not be hot right now because with COVID, people realize that they don't need as much space in their, in order to do business. So what are some hot ones right now? Industrial. So for instance, maybe a warehouse in LA down on the water where, there's a lot of, shipping coming in. Right now, I think the occupancy of industrial is like 97%. So that's a hot one right now. Depending on where you are in the country, right now there's a lot of multifamily being built. Although, if you ask me specifically about multifamily, fourplexes always make the most sense. They make more sense than duplexes in terms of cash flow. Most fourplexes, you could live in one unit for free, or you can rent all 4 units out and the 4th unit's going to make you all your profit. So fourplexes can be a great way when you're a young person and haven't bought a home yet. Go buy a fourplex and live in it, rent the other units out, and then maybe go buy a duplex next. And then maybe then go buy a home and keep these as rentals. But fourplexes can be a great way because they do cash flow really well.
That's a great segue into this question. They're asking, what would you recommend first steps into getting into a multifamily? This person currently owns several single family rentals, but is looking to kind of transition to the multifamily.
Yeah, I mean, if you go over a fourplex, then you're going to have to pay commercial interest rates instead of residential interest rates. So I owned a sixplex one time, twice. But for the most part, I've always owned fourplexes because you can get, residential interest rates, which makes a whole lot more sense. Right now, commercial interest rate could be 9.5. So buying a fourplex makes a ton of sense. If you're going to buy if you want to go over a fourplex, then you might as well go buy a 72 unit, something that, because of the number of units inside the building, it'll be okay if the interest is 9.5%. I just chose not to. I've made most of my money with fourplexes. Because you can own or occupy a fourplex, and no one will think a thing about it if you then go to a duplex and then you go to a single family. But if you're in a single family and now you want to go convince somebody that you're going to move from your single family and own or occupy your fourplex, they're not going to believe you. So you're going to have to be an investor and put like 20% down.
Would you invest in another market center at this time?
Depends on where it's located. Yeah, and I say this because there are some states that it's just hard to do business in, or harder to do business in.
Awesome. That's all the questions in the chat box at this time. Oh, we just had one more come in. When do you see the market prices coming down specifically on multifamily properties? In my market, the prices are still high with multiple offers.
Yeah, so typically, well, there's a couple of ways that you might see the multifamily coming down. One is if we have enough single family inventory that people actually start buying more houses. Typically in the US, we'll have 2.5 million houses on the market at any one time. That's normal. Right now we have 970,000. So we definitely have an inventory shortage. So that means that buyers that maybe would like to buy that are currently renting can't buy, or especially first-time homebuyers are super frustrated right now. And so if they can't buy, they're renting. So that keeps rents and rental values, because when you evaluate a multifamily property, they're not just looking at it in terms of the market approach. They're looking at the income approach and the cost approach. And so the income from those apartments is what derives a lot of the value. And so if the rents continue to be high, the values, the are not going to come down. If all of a sudden now we have 2.5 million houses on the market and people move out of rentals and actually start buying homes, especially first-time home buyers, you'll see rents come down. And when you see rents come down, the value of the multifamily comes down as well. Good questions. Any other questions for me? I will say this, there's parts of the country where values go up slowly and come down slowly. And there's parts of the country where values go up super fast and come down super fast. And I happen to just be lucky. I remember back in 2017, I bought a fourplex in Arizona. I paid $259,000 for it and sold it a year later for $369,000. Now that would never happen in Alaska. But I didn't go into it as a speculator. I truly went into it as an investor. But when it went up that fast, and then I realized that you couldn't build it for that. That's when I said, okay, I'm now it's really the value is over. I'm out over my skis, meaning the chances of ever being that high again are slim. So I chose to sell it, do a 1031 exchange into some duplexes and fourplexes in Kansas City.
Where do you usually find your properties?
Well, I would say this, if you don't have a great property manager, I mean, a property manager can make you or break you. Then I would want to have the properties near where I am, where I can go see them and visit them. And so that's why, when I lived in Alaska, all my multifamily were in Alaska. So in living in Arizona, I did have some multifamily and I sold them. I had a single family that I did a flip on and a multifamily also that I sold. And I bought in Kansas City because it's steady. It doesn't go up super fast, doesn't come down super fast. So I was buying in Kansas City because I knew I was going to own and hold them probably 10 years. So I know that they're going to do what I need them to do. And in 10 years, I'll own them free and clear. And then they're just going to be cash cows for me. So, but the key was a great property manager. The key was having a great agent help me find those properties. He helped me find all of them off market. So even during the height of the real estate market, I wasn't in multiple offers because they were all found off market. So, and then they had a great property manager that they had, dealt with for 10 years. And so otherwise, there's no way I would have bought property in Kansas City if I didn't have a great agent and I didn't have a great property manager. So hopefully that.
What I think I hear you saying is you kind of just let someone in your world know, hey, I have some money that I'd like to invest. Let me know if something comes up. The audience is kind of asking, like, how do you find those? How do you source your out-of-state investments? It sounds like really just letting people know what you're looking for and working with a good agent.
Oh, you're exactly right. So I happen to be in Gary's top mastermind group. So I let the agents in the top mastermind group that are my, that I know that I had done 1031. I had sold my properties and I needed to find, you have to identify within 45 days. See, I didn't have a long time or I was going to have to pay a lot of capital gains. So I needed my trusted friends to help me go find something. And, if you let people know that you're looking for something, there's a guy in our office, a military veteran, and he let one of the other agents that I'm a business partner with know that he was looking to buy his first home. And so anytime he saw something that he thought would meet his needs, he would let him know. And he ended up finding a house and buying it. But you've got to let people know. You've got to let people know.
Awesome. That's all in the chat for now. We are right at the top of the hour.
Now, our next wealth building series will be in April. There won't be one in March for a number of reasons. It's March Madness. It's spring break for kids. And my youngest daughter is getting married in Alaska. So I am taking the last 2 weeks of March off to spend up there with our family. And so I will see you guys back here on April 25th for the next wealth building series. And this is all taken from Gary, exactly what Gary has taught me in terms of the path of money. So we'll look forward to seeing you in April. And thank you so much for attending today.
Hi, everyone. Thank you.